Let me tell you what I do every morning before I look at a single market price, before I check equities, before I look at treasury yields, before I read a single analyst report or research note or financial news headline. I look at a dashboard that my team built over the course of 3 years that tracks 47 specific indicators across every major economy in the world: debt to GDP ratios, current account balances, foreign currency reserve levels, domestic banking system stress indicators, political stability indices, inflation trajectories, central bank credibility measures, bond market liquidity metrics. I built that dashboard because I learned something early in my career that most investors learn too late or never learn at all. The biggest financial opportunities and the biggest financial catastrophes in modern history have almost never originated inside the United States. They have originated in the periphery, in the countries that the mainstream financial press ignores until the moment they cannot be ignored anymore. And by the time they cannot be ignored, the opportunity to position correctly has already closed. The money has already been made or lost by the people who were watching the right indicators in the right countries before the collapse became front page news. Right now, that dashboard is showing me something that I have not seen in its current combination and intensity since the months before the Asian financial crisis of 1997. 5 countries simultaneously showing the specific pattern of indicators that has preceded every major sovereign financial collapse in the past 50 years. Not one country, not 2, 5. Simultaneously, at different stages of the same fundamental process. And the question that every serious investor needs to answer right now is not whether these collapses are coming. The data has already answered that. The question is which one falls first. Because which one falls first determines the sequence. And the sequence determines how the contagion spreads. And the contagion is what reaches into the American financial system and interacts with the vulnerabilities that are already built into it in ways that most investors are completely unprepared for. I am going to identify all 5 countries. I am going to explain precisely why each one is collapsing using the specific data points that my dashboard tracks. I am going to tell you which one I believe falls first and why. And I am going to explain exactly what each collapse means for your money and what you need to do about it before the sequence begins accelerating. I have been in markets for over 40 years. I ran Duquesne Capital for 30 years and generated an average annual return of 30% without a single losing year. Not one. I managed money for George Soros. I was the architect of the trade that broke the Bank of England and made over $1 billion in a single day. I have navigated 6 major financial crises, including the Asian financial crisis of 1997, which I positioned for aggressively before the mainstream understood what was building and which generated some of the most significant returns of my career. That crisis taught me more about sovereign financial collapse than any other event in my professional life, because it demonstrated with complete clarity how quickly a country that looks stable on the surface can go from functioning financial system to full-blown crisis when the specific combination of indicators I track reaches a tipping point. Thailand in 1997 did not look like a country about to have a currency crisis until it was. Indonesia did not look like a country about to experience a complete financial system collapse until it did. The warning signs were in the data for people who knew where to look. The mainstream missed them entirely until the crises were already underway and the best positioning opportunities had passed. I am not going to let that happen to the people watching this video today. Let me start with the framework for sovereign financial collapse, because understanding the pattern is the foundation for understanding why these 5 specific countries are at risk right now. Every sovereign financial collapse in modern history has followed a recognizable sequence of conditions. It begins with a debt buildup that exceeds the economy's capacity to service it through normal growth. That debt buildup is almost always obscured during the period it is occurring because the economy is growing and the debt appears manageable relative to current income. It continues with a currency that is either overvalued relative to economic fundamentals or pegged to a stronger currency at an unsustainable rate. The overvalued currency masks the debt problem by making interest payments appear manageable in local currency terms. It accelerates when foreign investors begin quietly reducing their exposure before the domestic population understands the risk. Capital flows out slowly and then all at once. And it culminates in a currency crisis, a banking crisis, or both simultaneously when the combination of debt service requirements, capital outflows, and loss of confidence in the financial system reaches the point where no policy response is adequate to restore stability. That is the pattern. It has repeated itself in Mexico in 1994, in Thailand, Indonesia, South Korea, and Malaysia in 1997, in Russia in 1998, in Argentina in 2001, in Greece in 2010, in Turkey in 2018, and again in 2021. Every single time, the same sequence, the same conditions, the same pattern of warning signs building in the data before the collapse became visible to mainstream investors. Right now, that same pattern is building simultaneously in 5 countries. And the combination of their simultaneous stress creates a contagion risk that is qualitatively different from any single isolated sovereign crisis. Here is the first country. Argentina. I know what you are thinking. Argentina is always on this list. Argentina has been collapsing in one form or another for 25 years. This is not news. You are right that Argentina has been in chronic crisis. But what is happening in Argentina right now is different from its previous crisis in a way that makes it the most immediately dangerous of the 5. Argentina has a new government that has implemented the most aggressive fiscal austerity program in the country's history, spending cuts of a magnitude that have no precedent in Argentine political history. The elimination of subsidies, the dismantling of price controls, a deliberate currency devaluation followed by a crawling peg designed to make the peso competitive. These policies are economically correct in the long term. In the short term, they are creating social and political stress that is testing the limits of democratic tolerance for austerity. The critical metric I watch for Argentina is not its debt ratio or its inflation rate. It is the political survival probability of the reform government, because the reform program only works if it is sustained. If the political cost of sustaining it exceeds the political capital available to the reform government, the program reverses. And the reversal of an austerity program of this scale in an economy with Argentina's structural vulnerabilities is not a return to the previous bad equilibrium. It is a complete collapse, a hyperinflationary spiral, a banking system freeze, a sovereign default that is categorically more severe than anything Argentina has experienced in the past 2 decades. The indicator I watch most closely for Argentina is the spread between official and unofficial exchange rates. When that spread begins widening again from current levels, it means capital controls are failing and the reform is losing credibility. That is the signal that Argentina moves from managed austerity to unmanaged collapse. Here is the second country, Pakistan. Pakistan is the sovereign financial crisis that the mainstream financial press has been systematically under-reporting for 3 years. And it is the one that carries the most severe geopolitical complication of any sovereign crisis currently building, because Pakistan is a nuclear-armed state with a population of 240 million people and a military that has historically exercised independent political authority regardless of what civilian governments decide. Pakistan's debt situation is catastrophic by any measure. External debt service as a percentage of export earnings is running at levels that leave virtually no margin for any additional shock. Foreign currency reserves have repeatedly fallen to levels covering less than 1 month of imports, which is the standard threshold for acute crisis. The IMF has been providing emergency support through multiple program cycles, but each program requires fiscal adjustments that the political system cannot sustain long enough to produce the structural improvements the program requires. The specific indicator I watch for Pakistan is its foreign currency reserve level relative to its upcoming external debt maturities. When the gap between available reserves and upcoming maturities closes to within 90 days of coverage, the country is in acute crisis regardless of what the official statements say. That gap has been dangerously narrow multiple times in the past 3 years. The structural conditions that created it have not been resolved. They have been temporarily papered over by IMF disbursements and bilateral loans from China and Saudi Arabia. When the bilateral support becomes conditional on political changes that the Pakistani military is unwilling to accept, the IMF program collapses and the foreign reserve crisis returns with a severity that previous episodes did not have. A Pakistani sovereign default and currency collapse would not stay inside Pakistan. It would immediately stress every bank and financial institution that has exposure to Pakistani debt. It would create a refugee and security crisis that would destabilize an already fragile regional environment. And it would test the credibility of the IMF and the international financial support system in ways that would reduce confidence in similar support programs for other vulnerable countries. Here is the third country, Egypt. Egypt is the most financially vulnerable large country in the world that most investors are not watching with the urgency its situation demands. With a population of over 100 million people, the largest in the Arab world, Egypt has been running a financial system that is structurally insolvent on its own terms for the better part of a decade. It has been kept afloat by a combination of Gulf state financial support, IMF programs, and an informal understanding among its creditors that an Egyptian financial collapse would create instability too severe for the region to absorb. The specific numbers for Egypt are alarming at every level I track. Debt service as a percentage of government revenue has been running above 40%, meaning almost half of every pound the Egyptian government collects in taxes goes immediately to pay interest on existing debt before a single service is delivered. The Egyptian pound has lost over 60% of its value against the dollar over the past 3 years as successive devaluations have attempted to align the official rate with economic reality. Inflation has been running at levels that are destroying the purchasing power of a population, where the majority of household income goes to food and energy. The indicator I watch most closely for Egypt is the sustainability of Gulf state financial support. The Gulf states, primarily Saudi Arabia and the UAE, have been providing Egypt with financial lifelines, not because the investment makes economic sense, but because they view a stable Egypt as a strategic necessity. When Gulf state domestic pressures, whether from lower oil revenues or their own diversification spending, reduce their capacity or willingness to continue subsidizing Egypt, the Egyptian financial system loses its external support precisely when it is most needed. The Gulf state fiscal position is a leading indicator for the Egyptian crisis timeline. Watch Brent crude. Below $70 per barrel sustained for more than 2 quarters, and Egypt's Gulf state lifeline begins to strain. Here is the fourth country, Turkey. Turkey is the crisis that has already happened twice and is setting up for its third and most severe iteration. In 2018, the Turkish lira lost 40% of its value in a currency crisis driven by the combination of a current account deficit, high inflation, and a central bank that was being prevented by political pressure from raising rates to levels that would have restored confidence. In 2021, the crisis repeated with the lira losing over 40% again, as the same political interference with monetary policy undermined the credibility of the inflation fight. What makes Turkey's current situation categorically more dangerous than its previous crises is the scale of the dollarization that has occurred in response to those crises. Turkish households and businesses, having watched the lira lose 80% of its value over 5 years, have moved an extraordinary proportion of their savings into dollars and euros held domestically. This creates a structural vulnerability that did not exist in previous crises. When confidence in the lira deteriorates, the conversion of domestically held dollar savings into capital flight is instantaneous and enormous. Turkish banks that have been funding dollar deposits with lira loans face a currency mismatch that becomes a solvency crisis the moment the exchange rate moves beyond a threshold that triggers mass conversion. The indicator I watch for Turkey is the ratio of domestic foreign currency deposits to total banking system deposits. When that ratio exceeds 60%, the banking system is so dollarized that any significant lira weakness creates a self-reinforcing spiral. Turkey is approaching that threshold. When it crosses it, the third Turkish lira crisis will make the first two look like minor corrections. Here is the fifth country, and this is the one that will surprise most people watching this video, because it is not an emerging market. It is not a developing economy. It is a developed Western nation with a long history of financial stability and institutional credibility. The fifth country is France. I have been watching France's fiscal trajectory for 2 years, and I have been reluctant to put it in the same category as Argentina, Pakistan, Egypt, and Turkey because the institutional framework around France, the European Central Bank, the European Union's fiscal architecture, the depth of European capital markets provides buffers that the other 4 countries do not have. But in the past 6 months, as I have watched France's political situation deteriorate and its fiscal trajectory become increasingly disconnected from its European obligations, I have concluded that France belongs on this list not because it is as immediately vulnerable as the others, but because it represents the systemic risk that makes the other 4 collapses globally contagious rather than regionally contained. France currently carries debt at approximately 112% of GDP. Its deficit is running at approximately 6% of GDP, which is double the EU's stability and growth pact limit of 3%. It has had 3 governments in 2 years, none of which has been able to pass a budget that addresses the structural deficit in a way that satisfies bond market demands. The French political landscape has fragmented to the point where no governing coalition can simultaneously win enough votes to form a government and maintain the fiscal discipline that France's debt position requires. The indicator I watch for France is the 08 bond spread, the spread between French government bond yields and German government bond yields. This spread is the bond market's real time assessment of the risk premium required to hold French debt relative to German debt. It has been widening for 18 months. When it reaches 150 basis points and continues widening, the European Central Bank faces a choice between letting French borrowing costs rise to levels that make the fiscal trajectory genuinely unsustainable or intervening in French bond markets in a way that the ECB's mandate and the political tolerance of Northern European member states makes extremely difficult. A French fiscal crisis does not look like an Argentine crisis. It does not happen overnight. It happens through a slow and grinding loss of bond market confidence that forces austerity measures on a population that has already demonstrated its unwillingness to accept them. But the consequence of a French fiscal crisis for global financial markets is categorically larger than the consequence of any of the other 4, because France is the second largest economy in the European Union, and the European financial system is deeply interconnected with the American financial system in ways that would transmit French stress directly into American balance sheets. Now let me answer the question that the title of this video poses. Which one falls first? My answer is Turkey, and here is the precise reasoning. Turkey has the most complete combination of the specific preconditions for a currency and banking crisis that moves from building to acute in a compressed time frame. The dollarization of the domestic banking system creates an instantaneous transmission from exchange rate weakness to banking system crisis that the other four countries do not have in the same form. Turkey's political structure, with executive authority concentrated in a single leader who has demonstrated willingness to override central bank independence, removes the institutional break that, in other countries, might slow the deterioration long enough for external support to arrive. Turkey's external financing needs. The amount of foreign capital it needs to roll over on an annual basis to keep its external accounts balanced are large enough that any reduction in international investor appetite for Turkish debt creates an immediate financing gap rather than a gradual one. The trigger for Turkey is a combination of domestic political stress over the cost of living crisis and a reduction in the carry trade flows that have been providing Turkey with short-term capital. When global risk appetite deteriorates, as it will when the American financial system stress I have been describing in previous analysis becomes visible, the carry trades that have been funding Turkey's external deficit reverse simultaneously. Capital flows out. The lira weakens. Dollar deposits convert to capital flight. The banking system faces the currency mismatch that the dollarization has created, and the crisis that has been building moves from slow and manageable to fast and uncontrollable in days. Turkey falls first. Argentina follows within months as the social and political tolerance for austerity reaches its limit under the pressure of a global risk-off environment that reduces the external financing available to support the reform program. Pakistan's crisis deepens as the IMF and bilateral support system is stretched by multiple simultaneous requests. Egypt faces the consequences of lower Gulf state support capacity, and France's fiscal crisis moves from a slow burn to a visible emergency as European financial stress from the other four combines with domestic political paralysis. Now let me tell you precisely what each stage of this sequence means for your money and what you need to do before the sequence begins. When Turkey falls first, the immediate impact on American financial markets is a risk-off shock. Investors reduce exposure to emerging market assets globally. Credit spreads widen. Equity volatility spikes. Investors seek safety in gold and short-term treasury instruments. This is the first wave. It is manageable if you are correctly positioned. It is damaging if you are not. When Argentina follows and Pakistan deepens, the second wave hits. The IMF and international financial support system is visibly strained. The ability of international institutions to contain sovereign crises is questioned publicly. Capital flows to safety accelerate. Gold moves higher. Equity markets that had recovered from the first wave sell off again, more severely as the systemic nature of the stress becomes undeniable. When the French fiscal crisis becomes visible to mainstream markets, the third wave is the one that reaches directly into the American financial system. European banks with French government bond exposure face balance sheet stress. American banks with European bank counterparty exposure face the same stress at one remove. The contagion channel from a French fiscal crisis to American financial system stress is direct, well established, and faster than most American investors understand. This is the sequence that the American banking system, already carrying $500 billion in unrealized bond losses and $1 trillion in maturing commercial real estate loans, is structurally ill-equipped to absorb. This is the sequence that turns the domestic vulnerabilities I have described in previous analysis from a contained domestic problem into a global contagion event. Here is exactly what you need to do right now, before Turkey falls, before the sequence begins, while the positioning is still calm and orderly rather than desperate and chaotic. Move cash out of the banking system and into Treasury bills at Treasury Direct. Gov immediately. The Turkish crisis, when it becomes acute, will create a global risk-off shock that reduces bank deposit confidence simultaneously across multiple systems. Being outside the commercial banking system before that shock arrives is not overcaution. It is basic financial hygiene given the specific sequence that is building. Increase physical gold to a minimum of 15% of investable assets. Gold is the beneficiary of every stage of the sequence I described. Risk-off shock from Turkey. IMF system strain from Argentina and Pakistan. French fiscal crisis creating European financial stress. Gold performs at every stage because it is the asset that investors reach for when the institutional frameworks they have been relying on are visibly failing. Exit high-yield bonds and emerging market bond funds immediately. These are the assets most directly in the path of the first wave when Turkey falls. The spread widening that accompanies a Turkish currency crisis hits high-yield and emerging market bonds first, fastest, and most severely. The exit window at current prices is open now. It will not be open when the crisis is front-page news. Watch the Turkish lira against the dollar every single day. A move of more than 15% in a single week is the signal that the first wave has begun. At that point, execute maximum defensive positioning immediately. Move remaining equity exposure to minimum. Increase gold and treasury bill positions. Prepare to deploy cash into distressed assets when the selling that the sequence creates reaches its maximum intensity. The 5 countries are collapsing right now. Turkey falls first. The sequence that follows reaches into the American financial system through channels that most investors are not watching and cannot see until it is too late to position. But you can see it now. You have the framework. You have the indicators. You have the sequence. You have the specific actions that protect your wealth through each stage and position you to build wealth on the other side. The only question that remains is whether you act on what you now know while acting is still the calm, deliberate choice. The answer to that question will define your financial outcomes for the next decade. Act now, before Turkey falls, before the sequence begins, before the window for orderly positioning closes. I know which side of this sequence I intend to be on. I have been positioned for it for 18 months. My gold is in place. My treasury bills are earning 5%. My exposure to the 5 categories most vulnerable to this sequence has been systematically reduced. Now you know what I know. Now you see what I see. The sequence is building. The first domino is the most unstable it has ever been.